Hello everybody and welcome back. This is Swati Gupta, Chartered Accountant. Today we are going to study International Accounting Standard 7, or you can say Indian Accounting Standard 7. These both standards can be studied together because there are no much difference between them. There's one important major carve. We'll discuss that in the end of this video definitely. The name of the standard is Statement of Cash Flow. In this we'll discuss the treatment of various transactions that are critical for cash flow. Before we go ahead, don't forget to check out the description box for whole playlist of Indias in Hindi and English, both the language, and PDF notes are also available in the description box. I think we're good to start. Let's begin. Let's first discuss the basics of cash flow. Cash flow includes both inflow and outflow of cash, okay? Whether it is coming into the business or it is going out of the business, both are considered while making a cash flow statement. Here another term comes, that is cash and cash equivalent. It is a much broader and larger term than cash. It includes cash but more than cash. What else? It also includes demand deposits. Like any deposit, any balance that has been kept with bank but can be withdrawn as and when demand arises. It has no such restrictions or lock-in periods. Whereas it never includes FD. FD means fixed deposit, because you know that FD has some lock-in period, some maturity date, some restrictions, and cannot be withdrawn as and when wanted. Okay, so therefore it is not considered equivalent to cash. Next, cash equivalent means that it is highly liquid investment and which can be easily convertible into cash as and when demand arises. Okay, these are considered into cash equivalent. For example, marketable securities, if they can be encashed as and when demanded, as and when demand arises, then they will be considered and classified under cash and cash equivalent. This includes all investment up to 90 days. If you have done any sort of investment but the period for which it has been done is up to 90 days, not more than that, then these investments will also be classified as cash and cash equivalent. A long-term investment for which on the balance sheet date the remaining time period for the maturity is up to 3 months, like up to 90 days or up to 3 months, it is not more than that. For example, today is the balance sheet date, the FD is of 5 years or any other security investment is of 5 years, okay? But on the balance sheet date only 1 month is remaining for the maturity, it will be redeemed on April, for example. Then such long-term investment will also be considered under cash and cash equivalent, okay? On the balance sheet date, if it can be encashed within next 3 months from the balance sheet date. Bank overdraft is generally a financing activity because bank overdraft is what? It is a facility given by bank to the customer to withdraw over and above the balance available in the account, okay? So it is basically a financing activity, it is providing funds to the business, okay, no doubt. But if it acts as an integral part of the business management, that for any business it is very mandatory to keep a bank overdraft and it keeps on rotating the money through bank overdraft, it keeps on repaying it and then again withdrawing it. If it is an integral part of cash management, then such bank overdraft will also be considered under cash and cash equivalent, will also be classified under cash and cash equivalent. Generally, it is financing activity. But if it is integral part of the cash management, then it will be classified under CCE, that is cash and cash equivalent. Equity investments, very important line. Even question arises on these concepts. Equity investments are never included in cash and cash equivalent. They are never included in cash and cash equivalent. Now, classification of activities. Under cash flow, there are 4 major heads. Firstly, 3 activities are there, and finally, a balance comes of cash opening, and then we adjust that with the closing balance and the remaining balance, and then you get your cash flow completed. Okay, so there is one investing activity, operating activity, and financing activity. These 3 activities are there. Okay, we'll discuss about them one by one. Objective of cash flow statement is, there are 3 main objectives. These are given in ICAI module also. Same 3 objectives. Generally it is not asked. Instead the statement or the practical questions are given. It provides information about historical changes in cash and cash equivalent, like what was the outflow, what was the inflow previously. Okay, the historical changes, it justifies or provides information to assess the ability of generate cash and cash equivalent. It also gives you an overview about the business capacity, ability to generate cash and cash equivalent. Okay, like the future cash flow, cash inflow, cash outflow. Okay, it also gives you an overview about the entity's capacity, entity's ability to generate cash. Other than this, to understand the timing and certainty of generation of such cash. Okay, when will it come, how much it will come, it is also known by the cash flow, because the P&L only shows you what profit or what loss has been done during the year or during that period, but it never gives you an overview of how much amount you have received or how much amount you have paid. For measuring the cash inflow and outflow, cash flow statement is made. Okay, profit and loss is another thing, and taking a cash flow, making a cash flow gives you an overview of the cash management. Okay, because it can be like you have done 2 crore sale, but only 10 lakhs has been received, 1 crore 90 lakhs are still in debtors. Okay, so your cash flow is weak, but your profits may be higher. It can be like your profits are higher, but your cash flow is weak. Other than this, it can be other way around. So it gives you an overview of the business, like what is the profitability. For that you make P&L, and what amount of cash inflow outflow is going on, you make cash flow statement. So there are 3 major points, 3 major objectives for which cash flow system is made. Next comes the benefits of cash flow statement information. Firstly, it provides liquidity and solvency ratio and analysis by which any company comes to know, any entity comes to know about their cash flow position, their repayment position, their default chances are higher or not, whether they are able to cover their liabilities or not, whether their assets are sufficient or not. Next, it helps to facilitate cash management. Okay, it gives you a control over cash inflow and outflow. It also gives you comparison between present and future cash flow. Okay, because you know historic changes can be detected from the cash flow statement, it gives you a chance of comparison between present and future cash flow. Other than this, it also helps entities to compare with another competing entities with their cash flow statement, because there are standard rules by which cash flow statement is made. Next, operating activity. Cash flow from operating activity is derived from the principal revenue producing activity, the major source of revenue, the basic core activity through which a business is running. Hence, they primarily relate from profit and loss of the entity. They are the major source of revenue. The core principal producing activity, revenue generating activity, is termed as operating activity. Any inflow and outflow related to such operating activity is classified and treated under the head cash flow from operating activity. There are some examples given of the inflow and outflow that are related to operating activity. Firstly, receipt from sale of goods and services, any goods and services, and you receive any inflow. This is inflow from operating activity. Whereas when you make purchases of goods and services and you make a payment, then that is outflow for relating to operating activity. Receipt from royalty, fees, commission, other revenue, anything other than that, and the payments related to employees, these all are inflow and outflow relating to operating activity. Next, receipt of any insurance entity, insurance premium. Okay, this is considered as inflow under the head insurance, under the head cash flow from operating activity. Okay, see, insurance premium. If you are an insurance entity, your business is of insurance, your main principal revenue generating activity is making insurance. So the insurance premiums that the entity receives from all the customers is the cash flow from operating activity, just for the insurance entity. Okay, similarly, cash payments of general business expenses, payment of taxes except when related to investing and financing. See what? Very important. If you pay any taxes for overall profit and loss of the business relating to operating activity. Generally, it is categorized under cash flow from operating activity, and no doubt in that. Okay, but if it is related to any certain investing or financing activity, then such tax paid related to such financing or investing activity is classified in under the such particular financing and investing activity. For example, if you paid some dividend, okay, so payment of dividend is your financing activity. Okay, you borrowed some amount on equity, okay, you issued shares and you borrowed amount from public. So this is your financing activity. Onto that you are providing any returns. So this is what? This is financing activity. Now on payment of dividends to the shareholders, now you have to pay DDT, dividend distribution tax. Such tax is directly related to financing activity, therefore such tax will be classified under financing activity. Other than that, the general taxes will be classified under operating activity. See, read the line again. Payment of taxes except when related to investing and financing activity. One more example, cash receipt on account of contract held for trading. Any revenue generating activity and for which you have received any payments, this will be classified under cash flow from operating activity. Next comes specific treatments. Okay, for example, profit and loss on sale of asset. It is generally a PPE item, property, plant and equipment item, and it is generally included in the P&L amount. Okay, when you make your profit and loss account, it is generally transferred into that. But while preparing cash flow, it is a part of investing activity. So you have to adjust from here and then make this treatment under investing activity. Accordingly, operating cash flow must be adjusted by the amount of such P&L account. We have to reverse that amount from the P&L and then we have to put that amount into the under investing activity. In case your business is of real estate, okay, you are real estate dealer, you are property dealer, okay. So in this case, any rent coming onto that property or any sale purchase of such property will be considered under operating activity, because this property and the related amount is your principal revenue generating activity, whereas in other cases, in general cases, it is an investment activity. Okay, property relates to held of rent or held for subsequent disposal is considered under operating activity if it is your core business. Cash outflow on construction acquisition is also operating activity. Whether it is inflow or outflow, whether you are purchasing it or selling it, both are included under operating activity. But generally it is investing activity for other businesses. For property businesses, it is operating activity. Interest income and expenses, okay, generally it is financing activity, investing activity. If you have invested anything and you receive any interest, it is investing activity. But for businesses like banks, for businesses whose principal revenue generating source is interest amount, okay, they deal in this such deposits and such investments, then this will be considered under their operating activity. Simple. To know the operating activity, you have to first see the principal revenue generating activity of such business. If it is directly related to that, it will be classified under cash flow from operating activity. Otherwise, financing and investing activity accordingly. Similarly, interest and dividend income and profit on sale of investment for investing activity, these are generally what? These are generally investing activities, but if your business is of bank and it is an integral part, okay, then it is classified as operating activity. Method of representation, there are generally direct and indirect, two methods are there, but generally you need to use the but Ind AS 7 use indirect method. Ind AS 7 uses indirect method. Indirect method and direct method. First we'll discuss direct method. Here generally what happens, you make a P&L using cash, okay, you do accounting according to the cash system, okay, instead of accrual system. What you do, you consider your revenue according to the cash system. Cash receipts from the sale of goods and rendering of services, collection from debtors, cash payment for purchases of goods and services, payment to creditors, whatever there is inflow, then add it. This is outflow, then deduct it. Okay, business expense payment, then cash flow before tax and cash paid, operating cash flow arises. Whereas indirect method, you have to classify the activities under 3 major heads, and then finally to balance out there comes cash and cash equivalent. Okay, so profit before tax comes, and then you adjust non-cash items, non-cash expenses, for example depreciation and all. These had been deducted from P&L, but they were not a part of it. So okay, you add them back. Non-operating expenses and losses, for example loss on sale of asset, interest expenses, and then these are diverted and adjusted into their specific investing and financing activity. See, simply I am trying to say is direct method is like accounting on the cash basis, and your indirect method is the division of activities into 3 main categories. Okay, this is an overview. For example, non-operating incomes, profit on sale of fixed assets, investments, interest, dividend, whatever. These all will go into what? Into their particular heads. Then after this comes working capital adjustment. This is very important. You can put a star over it here. For example, okay, what I consider is there is a balance sheet, for example. Okay, there is increase in current liability. This means liability side. This is liability side, and this is asset side. Okay, their current liability increases. This means correspondingly cash increases. Okay, you assume this, and therefore it is added. Similarly, if you see decrease in current liability, then current liability here decreases, and therefore cash also decreases to balance out the balance sheet, and therefore it is deducted. To consider this and make it easier, you can use this logic. After this, operating cash before tax, taxes are paid, and then comes cash after tax. Next, investing activity. Investment means sacrifice of current resources in view to get more returns in future. What you do, you pull up your resources, current resources, and divert them in order to make a better return in future. All entities need some amount of investment for this future survival. Okay, to ensure growth and survival, they need some sort of investment, whether in fixed assets, any sort of. Okay, depends upon business to business. Accordingly, Ind AS 7 prescribes that all cash flow on asset in investing activity except those assets which has been classified as a part of working capital. Other than working capital, all should be classified under investment activity. Examples are given. For example, receipt from sale of PPE, intangible asset, and other long-term asset. Any sale on that and you receive any amount, it is classified under investing activity. Okay, if you purchase such similar asset and you pay any amount, that is considered under outflow. Okay, if you acquire, you purchase, if you sell. Okay, receipt from sale of equity, debt, instruments held in other securities, any investments. Okay, and on the other hand, cash receipts from repayment of advances, loans made to other parties. Okay, you have done advances. Advance is what? Your asset. Okay, if you have done advance, if given advance, then this is your outflow. Whereas if you receive any advance, then it is your inflow. Or if you receive repayment of your advance, then this is inflow. Cash receipt from future, forward, other options, swaps and all. Okay, any financing activity, then if you are receiving it, then it is inflow. If you are paying it out, if it is outflow from the business, then it is considered as minus, or you can say outflow. Similarly, next comes financing activity. During the life of any entity, it needs money. So the sources through which it generates money for the business, cash for the business, these sources are known as financing activities. These transactions will be considered as financing activities. Okay, for need of money, funds are raised and repaid as per the agreement. Okay, where the way you borrow, there is always some agreements done of the repayment. Okay, and then you have to repay it back. So if you borrow, there is addition to the business, then it is considered as inflow. If you pay back, then there is deduction from the business, and therefore it is deducted from under the financing activity. It is outflow from the business activity. All such flows are classified as financing activity. Examples are given. For example, cash proceeds from shares or other equity instrument. You issued shares and in return of that you got money. There is an addition to the business, then it is considered as inflow. Similarly, cash proceeds from issuing debentures, loans, similar. Short-term loan, long-term loan, whatever it is. In case if you are receiving any money into the business, then it is inflow. If you are paying back, then this is outflow. Reconciliation. All cash flows are classified generally as reconciliation items for which management decision is still pending. Such items are called CCE items. Next, reporting cash flow on net basis. Okay. For example, you bought an asset, okay, of rupees 1 lakh, okay, and sold it for 80,000, for example. Okay. So you never treat 20,000 in your cash flow. Cash flow 20,000. Okay. You sold this, you get an addition. You purchase this, this was minus. So there is minus 20,000. It is never treated this way, never on net basis. Instead, what happens is you do a gross transaction treatment. For example, if you bought it, you deduct 1 lakh and then when you sell it, you add 80,000. This is how two treatments are shown instead of this one figure. Okay. But whereas the requirement is contractually and mutually agreed to show on net basis, then only net reporting is done. Otherwise, generally it is always reported on gross basis. Foreign currency cash flow. Okay. All cash flow in foreign currency shall be recorded using rate at the date of cash flow statement. Okay. The date on which you are preparing cash flow statement, the conversion of foreign currency, the rate will be taken of that particular date. Exchange gain loss, if it is not realized, then it will not be considered in the cash flow statement. And if it is already considered, then you have to reverse it back and adjust it. Okay. Or you can say you have to eliminate the unrealized gain and losses that have been already booked. You only book when it has been realized in the cash flow statement. Okay. Taxes on income. Okay, I have told this beforehand also that if it is related to any operating activity or general cash flow, cash payment of taxes, then it is included under the cash flow of operating activity. But if it is directly related to any particular financing or investing activity, then such tax payment needs to be classified under such cash flow from operating or from investing and financing activity. Okay, if it is directly related to such particular treatment, then it will be treated under that particular activity. Otherwise, general taxes are treated under cash flow statement for cash flow from operating activity. Okay, there is an example also given. For example, TDS on interest, income capital gain tax or disposal on asset, then this is investing activity. Okay, any capital gain tax that you are paying is what? It is related directly to the investment activity and therefore classified under cash flow from investing activity. Okay. Changes on ownership relation in subsidiary or other business. Control obtained, then investing activity. Control lost, then investing activity. Other than that, if control change is there, see, importantly, please pay attention here. If control changes, then it should be considered as investing activity. Okay, but if control remains same, see, but if control remains same, then this is always considered as financing. Very important, even from the point of view of the question solving. Okay, if there is control change, then it is investing activity. For example, see, existing, for currently you were having 80% share of any company A, and then you sold out 50% shares. Now remaining is what? 30%. 80% control, you had major control, now you don't have major holding, so your control is changed, therefore it is considered as investing activity. Clear? Try other ones. See, currently you were having, for example, 10% holding of any shares in a company, then you purchased another 80%, now it leads you to 90%. 10% you did not have holding, major holding, okay, but after purchasing this 80% additional, you have a major control, okay, the control has been changed, therefore it is investing activity. Another example, there was 100% control, you had 100% control, you sold out 80%, now remaining, you sold out 20%, remaining is what? 80%. There was major control, and still after even selling out 20%, you still have major control. The control has not changed. The major control is, even after deduction, is major control. Control not changed, control remains same, then it is financing activity. Next and lastly comes carve out. Okay, there is one important carve I promise that we will discuss in the end of this video. Here it is. Okay. The International Accounting Standard 7 gives an option to classify the interest paid and interest and dividend received as item under operating cash flow. Okay, Ind AS 7 never provides this option. Okay, so this is a carve out. International Accounting Standard 7 gives you an option, whereas the Indian Accounting Standard 7 never gives you an option to classify such interest and dividend as operating activity. Okay, similarly here, International Accounting Standard 7 gives an option to classify dividends paid as operating activity, whereas Indian Accounting Standard Ind AS 7 never provides an option to classify such dividend paid as operating activity. It always have to classify it as financing activity. Okay, so this option is given into International Accounting Standard 7, but such option has been removed from Indian Accounting Standard 7. Okay, I hope you understood this standards very much clear. Okay, in case of any doubt, please reach out to us, comment down below. Please hit the like button if you like the video. Also, for PDF notes, you can check out the description box. It is available. The link is available to check out whole playlist in Hindi and English language. The link is available on the channel and in the description box. Don't forget to check out. See you in the next videos. Till then, take care, be safe, stay tuned.